Here to discuss this and more is Isaac Boltansky, BTIG's Director of Policy Research. Isaac, thank you so much for joining us this morning. I want to start with these developments from the G20 nations, or lack of developments rather, from those weekend meetings. And since the COP26 is now underway, what are your expectations for what we should see at this year's UN climate conference over the next couple of weeks? And what kind of global coordination are you expecting to come from these talks?
Good morning. Thank you for having me. I think the president said it better than I can say it. It was disappointing. The G20 did not deliver much more than what was expected, which was an official endorsement of the new global minimum tax regime. And the fact is that that old maxim that showing up is half the battle really matters. And it's difficult to get global, multilateral buy-in for some of these important issues when you don't have the major players showing up. And so I'm bearish on any big announcements out of this, out of the COP26, because we don't have some of the large players, whether that's Russia or, to me, more importantly, China, the largest emitter of greenhouse gases in the world.
Isaac, do you think it's going to be hard for big global corporations to support some of these Biden climate measures when essentially the administration is saying, hey, we're going to raise your taxes?
Yeah, look, I think that I want to talk about taxes, I think more broadly, but look, on the energy front, when we go through what's in this package, a lot of it is focused on credits, right? So we have more of the carrot on the energy side than originally was thought, with the stick, as the president had originally proposed and some of the more progressive wings elements of the Democratic Party asked for. And so really in that package that we saw last week from the White House, it was primarily tax credits, and we didn't have as many headwinds in terms of the different policies for large corporations. To me, the question in all of this is long-term stability. Most of my corporate contacts and everyone you have on your show says that what they're looking for is clarity and stability on the tax code. And my answer to clients has been, I think we're still going to get a package. And I think that we should be happy. No one's going to jump for joy, but happy with it, because it's going to be the tax code for a few years. And the underpinning of my view there is the House is probably going to flip next year. If you just look at historical trends, it looks like we're going to have a divided government next year, which means that corporations can plan for at least a couple years before we have to start talking about tax reform all over again.
Isaac, and when you think about tax reform and what sorts of policies could ultimately emerge in order to fund both the infrastructure package as well as that social infrastructure reconciliation bill, what do you think is the base case here for funding, and what should investors be expecting from the tax side of these policies?
Yeah, I'll tell you what I tell my clients. Number one, I think that the top line figure will go no higher than 1.5 trillion. I think that 1.75 trillion that the White House proposed last week is going to have to be bid down to get Senators Manchin and Sinema. Number two, on the pay-fors, I think that it's important to note here that the worst case scenario for corporates is off the table. Senator Sinema has made it clear that her view is that we should not touch the corporate rates. Same is true for Senator Manchin, who showed more willingness to go up closer to 25, but appears to have embraced some of these alternative pay-fors. And point number three is we've got to figure out what the alternative pay-fors are. It seems as though there's some consensus around a minimum tax for corporations, which again was embraced by the G20 in their official capacity over the weekend. I think that is something that we should expect. I also think that we're going to have a new construct around taxes for the ultra wealthy, however that's described, whether it's 10 million or 25 million in income. Some of the more left field proposals, like a billionaire's tax, never gained any momentum and appear to be fully off the table at this point.
Something you wrote about recently, Isaac, caught my attention. Tomorrow is a key hearing on the buy now, pay later industry. Now, we talked to a firm's founder, Max Levchin, last week. He seems to be okay with regulation. What do you expect to come from this hearing tomorrow, and do you think the space is at risk here?
So I think that investors around the BNPL space should be cognizant that DC now has its eye on that sector. It's been growing quickly. I think that DC is, of course, going to be looking at all of consumer finance now that it has a new head of the CFPB. But buy now, pay later is nearing the top, just given its rapid growth. My line to investors is that ultimately regulation benefits scale players, right? Let's not overthink this. If you have enough scale and enough capacity to invest in the regulatory framework, then you will ultimately benefit. My one cautionary tale is that we should expect headlines like this hearing tomorrow, and possibly even enforcement actions over the near term that I think will be focused on the marketing of this product. That's what regulators care about, are the terms and conditions and all of the different attributes clearly outlined for consumers. I think everyone in DC is okay with aspirational finance, as long as it's clearly outlined what that entails. And so I actually think the buy now, pay later industry is innovative, and I think that it has a great product, but we are going to have some new regulatory strictures, especially around the marketing of that product.
All right, Isaac Boltansky, BTIG's Director of Policy Research, thank you so much for joining us.